Greetings, finance enthusiasts, and welcome to HouseLux Estate. We're your go-to platform for all things finance. Here at HouseLux, we're all about empowering you to grow your wealth. We provide insightful guidance on investments, spotlighting opportunities to maximize returns and minimize risks. Whether you're a seasoned investor or just starting out, you'll find value right here. We tackle everything from real estate to bonds, equities, and beyond. So buckle up, because we're about to embark on an exciting journey. Stay tuned for today's topic, how to start investing in bonds. Before diving in, it's crucial to understand what a bond is. A bond, in its simplest form, is a loan. But instead of you going to the bank for a loan, you are the bank lending out your money. You're lending to entities like corporations or the government. These entities need funds for operations, infrastructure projects, or even to pay off older debt, and they're willing to pay interest to borrow your money. When you purchase a bond, you're effectively buying a promise. The issuer of the bond promises to pay you back the amount you lent them, known as the principal, at a specific date in the future, also known as the maturity date. In addition to this, they also promise to make periodic interest payments to you, the lender, throughout the life of the bond. The interest rate is often referred to as the coupon rate. So why would you want to invest in bonds? There are several reasons. First, bonds typically provide regular income through interest payments. This makes them attractive to investors seeking a steady cash flow, like retirees. Second, they are generally considered less risky than stocks. Even if a company goes bankrupt, bondholders are paid before stockholders. Bonds also add diversification to your portfolio. They often perform differently than stocks over economic cycles, so having both in your portfolio can help balance out returns. Lastly, certain types of bonds offer tax advantages. For example, interest earned on municipal bonds is generally exempt from federal taxes, and potentially from state and local taxes too. However, it's important to note that like any investment, bonds come with their own set of risks. The issuer could default on their payments, interest rates could rise, reducing the value of your bonds, or inflation could erode the purchasing power of your fixed interest payments. Now that you have a basic understanding of bonds, let's move to the next step. There are several types of bonds available for investment. Let's dive in and explore some of the most common ones. First up, we have government bonds. These are issued by national governments and are often seen as a safe haven for investors due to their low default risk. The interest you earn, known as the coupon, is typically lower compared to other types of bonds, but the trade-off is greater security. Next, we come to municipal bonds. These are issued by local governments or municipalities, often to fund public projects like schools or infrastructure. They come with a unique perk. The interest earned is usually exempt from federal and sometimes even state and local taxes. Lastly, let's talk about corporate bonds. These are issued by companies looking to raise capital. They typically offer higher interest rates to compensate for the greater risk compared to government or municipal bonds. But remember, if the company goes under, you could lose your investment. Each of these bond types comes with its own unique set of features and risk-reward trade-offs. Government bonds might appeal to those seeking stability, municipal bonds to those looking for tax advantages, and corporate bonds to those willing to take on a bit more risk for potentially higher returns. Choosing the right type of bond depends on your investment goals and risk tolerance. So think carefully about what you want from your bond investments and make a choice that aligns with your financial objectives. Now let's delve into the process of purchasing bonds. First and foremost, you'll want to do your homework. Researching bonds is an essential first step. You'll want to understand the terms, the interest rate, the maturity date, and the creditworthiness of the issuer. Credit rating agencies like Moody's, Standard & Poor's, and Fitch Ratings can provide you with valuable information about the issuer's creditworthiness. Remember, a high credit rating indicates lower risk, but also typically means a lower interest rate. Next, you'll need to determine how much you're willing to invest. Consider your financial goals, your risk tolerance, and your investment timeline. For example, if you're saving for a short-term goal, you might opt for a lower risk, lower yield bond. If you're investing for the long haul, you might be willing to take on a bit more risk for a higher potential return. Once you've done your research and determined your investment amount, it's time to make the purchase. You can buy bonds through a brokerage account, a mutual fund, or a government agency like the U.S. Treasury. If you're new to investing, a brokerage account or a mutual fund can provide you with guidance and resources to help you make informed decisions. When buying through a broker, remember to ask about the commission or markup they charge. This can impact your overall return on investment. If you're buying through a mutual fund, be aware of the fund's expenses and management fees. If you decide to buy directly from the U.S. Treasury, you can do so through the Treasury Direct website. This can be a cost-effective option, as there are no commissions or markups. And there you have it. You've taken your first step into the world of bond investing, but the journey doesn't end there. Once you've purchased your bonds, it's time to manage your investment. Investing in bonds doesn't end at purchase. It's a journey, not a destination. Once you've added bonds to your investment portfolio, it's important to keep a keen eye on how they are performing. Monitoring your bond investments is essential, not just for tracking their progress, but also for making informed decisions about future investments. This could be as simple as checking in on your bonds regularly, using financial news and updates to keep abreast of market trends. Diversification is another key aspect of managing your bond investments. You wouldn't want all your eggs in one basket, would you? Spreading your investments across different types of bonds can help to balance risk and return. And then comes the question, when should you consider selling your bonds? Well, there's no one-size-fits-all answer to this. It depends on various factors like market conditions, the bond's performance, and changes in your financial goals. For instance, if a bond's issuer is facing financial troubles, or if interest rates are expected to rise significantly, it might be wise to sell. Managing bond investments is not about timing the market, but about strategic planning and informed decision-making. It's about being proactive, not reactive. It's about understanding the market dynamics and aligning them with your financial goals. Remember, the goal is to maximize returns while minimizing risk. Let's recap the key points we've covered today. First, we discussed what bonds are. They are essentially loans that you give to an entity, be it a government or a corporation. In return, you receive interest payments during the life of the bond and the principal amount when the bond matures. Bonds are a critical part of a well-diversified investment portfolio, providing a steady stream of income and a counterbalance to the volatility of stock investments. We then moved on to the different types of bonds. Government bonds issued by the federal government are considered the safest. Municipal bonds issued by states, cities, or counties offer tax advantages. Corporate bonds issued by companies generally offer higher yields but come with more risk. And finally, we have international bonds, which give you exposure to foreign markets. Next, we broke down the process of buying bonds. It starts with determining your objectives and risk tolerance. You can buy bonds directly from the issuer during the initial offering or from other investors in the secondary market. You'll need a brokerage account to do so. We also mentioned bond funds and ETFs as options that offer diversification and professional management. Then, we delved into managing your bond investments. This involves monitoring the performance of your bonds, staying updated on market conditions, and adjusting your portfolio as necessary. We stress the importance of reinvesting your interest payments to compound your returns. And we talked about laddering, a strategy of buying bonds that mature at different times to balance risk and return. Remember, investing in bonds is not a get-rich-quick scheme. It's a long-term strategy that offers stability and predictable income. And while bonds are generally considered less risky than stocks, they do come with their own set of risks. Interest rate risk, credit risk, and inflation risk are just a few examples. So always do your due diligence and consider seeking advice from a financial advisor. As with any investment, knowledge is power. The more you understand about bonds, the better decisions you can make. And don't be afraid to start small. Even a modest investment in bonds can grow over time and contribute to your financial goals. That's it for today. Don't forget to like, share, and subscribe to House Lux Estate for more investment tips and tricks. Stay savvy, investors.